It's my pleasure to be speaking to you for the next 45 or so minutes about responsible investment. Before we kind of kick off, I'll just say that I know there are folks in the room that might be kind of newer trustees. There's a lot of kind of concepts here that might be new. There are others in the room that have much more experience with responsible investment than I do. But really, I think the objective of the next 45 minutes or so is to ensure that all of us in the room have kind of a baseline understanding around what responsible investment is, why it's important, and what it looks like in practice. So with that, we can kind of kick off. So the agenda for the next kind of session is going to be, we're going to kick off with some foundations of responsible investment, looking at some definitions, some drivers, as well as some key ESG focus areas. We're also going to take a look at what responsible investment implementation strategies look like. Then we're going to move to the practical. So what does responsible investment implementation actually look like? There we're going to take a look at a few case studies. And then after that, we'll have a little bit of time towards the end, hopefully, for some Q&A. Okay. So starting with what is responsible investment? So responsible investment is an approach to investing that incorporates environmental, social, and governance, or ESG factors. There was a really good question around what that acronym meant earlier. So it incorporates ESG factors into the investment decision-making process to better manage risks. To better manage risks, generate sustainable long-term returns, and align investors with the broader objectives of society. There are kind of 5 key reasons that I can point you to for why an investor should consider responsible investment, why it's important, starting with financial materiality. So there's actually an increasing amount of industry and academic research that shows that there's actually a relationship between ESG factors and performance. The UN, the United Nations Principles for Responsible Investment, actually commissioned a bit of research that showed that engaging with companies on ESG issues can create better value for the businesses as well as their investors by encouraging better risk management and more sustainable practices. I'll kind of point you to 2 examples of ESG issues having a kind of financial link. One is in 2019, there was a dam that's owned by the mining company Vale, and that dam actually collapsed. This unfortunate incident led to the deaths of at least 270 people, and it caused extensive damage to the communities as well as to the environment. Following this horrific incident, the company actually had to pay over $7 billion to settle related claims. Another example, kind of around the governance piece. So in 2020, the payments firm Wirecard filed for insolvency, so they went bankrupt because of accusations of accounting fraud linked to corporate governance failings. So that's the first kind of reason. The second one is fiduciary duty. So of course we heard from Suzanne earlier today about what fiduciary duty is. So I won't get into too much detail around this point. But again, fiduciary duty really exists to ensure that those managing people's money act with the appropriate care, skill, and loyalty, and in the interests of the beneficiaries. Next is policy and regulation. So investors might consider ESG factors because there are certain policies or regulations that actually require them to do so. And these can kind of vary country by country and depending on asset owner type, et cetera. Next is stakeholder expectations. This is a really kind of important one because community members can actually have certain expectations around how you're managing that capital to ensure that it lasts for generations. So yeah, there's stakeholder expectations. And then lastly, we have sustainability outcomes here. So investors might undertake responsible investment to ensure that their investment activities are resulting in positive, not in negative outcomes for both people as well as the planet. Now, Responsible investment, now that we've kind of looked at some of the key reasons that an investor like the folks in the room might want to undertake it, responsible investment has actually evolved quite a bit in the last 3 decades. So when kind of ESG, and it's come under different names, SRI, many different acronyms, but responsible investment, say 30 years ago, was really thought to be much more kind of niche. It focused on, maybe only a specific handful of companies, typically in public equities, and it was really being undertaken by only a handful of investors. So maybe some kind of like values-driven investors, like religious investors as an example comes to mind. If we fast forward to today, kind of 3 decades later, responsible investment is widely recognized by investors to represent both risks and opportunities for all companies, and investors recognize that it can have a material impact on long-term performance. Today, responsible investment covers a range of different strategies and approaches. We're going to talk about some of those strategies a little bit later on in the presentation. It also kind of spans across various asset classes, so it's definitely not just limited to public equities, and we'll have some presentations on kind of responsible investment in private markets later on in the summit. So yeah, really I would say that it's a much more robust environment around ESG today. I was taking a look at a report that came out by the Canadian Responsible Investment Trends Report in 2023, and that report showed that the top 3 motivations for institutional investors in Canada for considering ESG factors were actually minimizing risk, improving returns, and fulfilling financial fiduciary duty. Furthermore, 85% of the investors that were surveyed in that report actually said that they expected returns at least as high, if not higher, than the market average whilst considering ESG factors. Okay. So what are some examples of ESG issues? We heard a little bit on this from Scott earlier today, but again, so E being environmental, some kind of issues that come to mind here: climate change, biodiversity protection, deforestation, water protection. If you look at the S, some kind of key social factors are worker and human rights, indigenous rights and economic reconciliation, conflict-affected areas, and there's a panel on that at the summit this week as well, diversity, equity, and inclusion, and then on the G, so the governance aspect, this includes board composition, executive compensation, bribery and corruption, tax transparency, just as a few examples. Before we keep kind of moving forward in the presentation, it is important to acknowledge that these issues are not mutually exclusive. And also you'll notice that in this chart at least, economic rights and indigenous rights and economic reconciliation are kind of under the S category, but definitely I think there's a kind of growing consensus across investors that these issues span across the E, across the S, and across the G. And a really tragic case study that illustrates just this is the fallout from the Rio Tinto mismanagement of indigenous relations and rights. So the Yukon Gorge is a 46,000-year-old sacred site. It's in Western Australia, and the mining company Rio Tinto actually, despite warnings from the traditional owners of the gorge, actually, kind of blew up parts of the gorge in 2020. And they were trying to access higher grade iron ore. One thing that's, again, I think sad about this case is that when Rio Tinto did this, it was actually not illegal. Technically, the Western Australia government actually, under legislation, they were able to have this kind of blast. And what resulted, though, was a watershed moment, a reckoning in Australia, and also it got a lot of international coverage, where people said this was not okay. It was not okay that Rio Tinto did this. In kind of preparation for this presentation, I was watching some of the testimonials from the traditional owners of the land, the PKK peoples, and what they said and afterwards, in the aftermath, really resonated not just with kind of media outlets in Australia, but also worldwide. Coming out of this incident, Rio Tinto's actions were described in federal parliament as inexcusable and as an affront to not only the PKK peoples, my apologies, but also to all Australians. There was a report that came out that was entitled Never Again. And what it said was that Rio Tinto, the company, knew the value of what they were destroying, but they blew it up anyways. Following this, Rio Tinto faced potential fines of up to $250 million, but watching the kind of testimonials of the peoples that have stewarded this land, they said that heritage can't be kind of brought back. No amount of money can really replace what's been lost there. Subsequently, in the following year, in 2021, shareholders of Rio Tinto actually voted no on a compensation package to executives at the company, saying we're not going to reward you after what has just happened here at the Gorge. And in the wake of this incident, the Australian government introduced new legislation, so heritage protection legislation. I will just note that the legislation requires consultation, but not consent, so it did kind of fall short of expectations. But nonetheless, I think this case and the mismanagement in this scenario really does indicate and show how ESG factors can have reputational damage and how they also could carry real material financial risks. Now that we've talked a little bit about what responsible investment is and why it's important, I want to speak a little bit about what some responsible investment strategies look like. So broadly, we can break this out into two kind of buckets. We have asset selection on the one hand, and then stewardship on the other. Asset selection is really about what you do at the onset, and then stewardship, once you've selected those assets, is about how you continue to manage them on an ongoing basis so that they're managed in a responsible way. On the asset selection side, so first of all, we have ESG integration. This is where you're explicitly and systematically embedding ESG issues into traditional financial analysis. So with ESG integration, the portfolio manager or the investor combines ESG data together with traditional financial metrics when assessing a company's value. Next, we have screening. So screening is about the exclusion of specific sectors, specific companies, countries, or practices from your portfolio. Typically, it's based on kind of ethical or value-based criteria. Examples of this is, for example, screening out weapons from your portfolio or animal testing or other things like that. On the kind of flip side of screening, we have thematic investing. So thematic investing is when you're actually targeting specific ESG outcomes. So this can be, you're looking to ramp up affordable housing, or you're looking to invest in women in leadership, cybersecurity, et cetera. On the stewardship side, first of all, here we have engagement. So engagement is where you're discussing ESG issues specifically and directly with companies to improve their management and their disclosure. Share actually does this on behalf of its clients as well, on behalf of its asset owner clients. Next along the line, we have proxy voting. Proxy voting is where you're using your voting rights and your voice to either support or oppose specific ballot items that come up at annual general meetings or AGMs of companies. And these can be resolutions that are either put forth by shareholders, so the executive compensation package that I mentioned from the Rio Tinto example was one, or they can be items that are kind of put forth by the management of a company as well. And then last, but certainly not least, and we will dive into this one a little bit more, it came up as well a little bit in the presentations prior, is asset manager oversight. So this is about monitoring your asset manager's performance to ensure that they're kind of aligning with your expectations around different ESG issues. If we move to the second part of the presentation, I want to take some time to kind of look at responsible investment implementation. So if you're just kind of getting started, you're going to begin with assessment. I see that the text is a little bit small on the slide, but hopefully you have some printouts as well. Starting out with assessment, this is really about taking stock of where your trust is at. So determining what current responsible investment approaches you're taking, what is in your investment policy, and so on. Next along the line, we have education, a little self-promotional, but I would say being here today is part of that education piece. But certainly there are other types of education that are available to asset owners. So this is, where you're kind of undertaking training for, that is tailored to both your needs and interests. Next along the line, and we're gonna unpack this one a little bit more in just oh, I've lost my slide. There we go, thank you. Next, we have defining your beliefs, and we will get into this in just a few moments, but this is where you're articulating your organization, so your specific trust, for example, your beliefs related to responsible investment and ESGI, the I there is Indigenous issues. Once you have your belief, you want to codify them into your responsible investment policy. So you want them in writing because you can't hold your asset managers, your consultants, et cetera, to a certain bar if you haven't clearly articulated what that bar is. Which brings us to implementation. This is where you're working with your consultants, your managers, and other service providers to implement responsible investment approaches. And then last here, we have the monitoring bit. So you're going to incorporate your responsible investment into regular oversight and on a kind of ongoing basis. And we have this nice little timeline here, but this process is not linear. So that might look like coming back and evaluating your beliefs or looking at your policy. As was mentioned, you can do that, at the very least on an annual basis, but it might be more than that. Looking at how your asset managers are performing, not just 1 year, but 3 years down the road, 4 years down the road, 5 years down the road, et cetera. So I want to take a moment to unpack the piece around developing your responsible investment beliefs a little bit further. So responsible investment beliefs, that's really the kind of foundation for embedding responsible investment policies and practices, including asset allocation, portfolio construction, asset selection, shareholder engagement, and proxy voting. Your investment beliefs set out the fundamental perceptions of the kind of trustees that sit at your trust and their institutions on the nature of financial markets and the role that you play in these markets. Your investment beliefs also clarify and make explicit the ideas and convictions upon which your policies are built, implemented, and monitored. They are considered to be a common factor in successful trust governance. They contribute to alignment with the organization's mission and a consistent approach across the investment portfolio. And last, they help organizations work effectively with their service providers. I have a few examples of responsible investment beliefs. I won't go through all of them, but maybe if I just start with the first two here. So the University Pension Plan in Ontario says, long-term financial value creation can be sustainable only if it is a subset of societal value creation. The Oneida Trust Committee says, the trust recognizes the responsibility to invest in a manner that does not enable harm to the environment or the spiritual and cultural values of Native Americans. So for each individual trust, you're going to have to kind of come together and define what your organization's responsible investment beliefs are. Once you have those responsible investment beliefs, that's when you start to kind of embed them into your SIP, as was mentioned earlier. Yeah, there's different kind of acronyms for this, but again, the SIP is your Statement of Policies and Procedures. And in your SIP, you want to include expectations of service providers, and you want to try to get really specific here around how they consider ESG issues in their portfolio construction and in their stewardship approaches. And your SIP can also refer to international standards of responsible business practice. We have an excerpt here from the First Peoples Cultural Foundation, who I believe are in the room. I don't think I've met yet. Yeah, there we go. Hi. So this is an example highlighting some of the kind of international norms and frameworks in your SIP. So this one says, the foundation recognizes the following standards of responsible business conduct: the Global Compact, the International Labor Organization Fundamental Principles and Rights at Work, the Organization for Economic Cooperation and Development's Guidelines for Multinational Enterprises, the UN Guiding Principles on Business and Human Rights, and the United Nations Declaration on the Rights of Indigenous Peoples. So as a starting point, their SIP says that we recognize kind of all of these key responsible standards. And then last, I want to talk a little bit about service provider alignment. So here I would say that it's really important for asset owners, such as yourselves in the room, to work with service providers that are aligned with your responsible investment beliefs and priorities. Ultimately, your kind of service providers, they work for you. So, what this looks like is it looks like integrating responsible investment expectations into your RFPs. Heard a little bit about that earlier this morning as well. Your fund mandates, your asset manager agreements. It means understanding how your consultants consider managers' responsible investment performance as part of their fund and manager selection. You would want to evaluate your service providers on their approaches and commitments to reconciliation. So, what do they have on their website, for instance? You can also ask them different questions around their commitments to reconciliation. And then, what you would need to do is figure out, are there gaps between your expectations and then what your asset managers say that they're doing around reconciliation? And then one thing you can consider around this is conducting an annual evaluation of your asset managers on their responsible investment performance, again, in keeping with your organization's specific priorities. Okay. We have an example here, an example of proxy voting oversight from Coast Funds. Several of you will have met the Coast Funds folks last year at the summit. But really, so Coast Funds was created in 2007. It's an Indigenous-led conservation finance fund, and they began considering how their voting rights, so again, that's voting rights at public companies' annual general meetings, or AGMs, how their voting rights as shareholders were being used. They worked with SHARE, they worked with George and Bell together to examine how their proxies were being voted, and what they found through that audit was that their asset managers were actually voting with management, so with the management of the companies, 95% of the time. That's not a bad thing in and of itself, but what that meant was that their asset managers were actually voting against shareholder proposals on human rights, on gender diversity, on corporate lobbying, all of which were priorities for their fund. Subsequently, SHARE collaborated with Coast Funds to develop proxy guidelines. And this is really key. It was mentioned earlier today as well. Proxy guidelines that reflect their values and prioritize rights respect. So just to give you another example of a kind of shareholder resolution that came up last year. Last year at the company Citigroup, there was a shareholder resolution filed asking the company to review its approach to protection of Indigenous people's rights. If you have clear language around your kind of commitment to uphold Indigenous rights in your portfolio, in your SIP, then it makes it easier to go to your asset manager if they're not voting in alignment with that and hold them accountable on that. Okay, it's cut off a little bit, but I think you kind of get the gist. Last but not least, I want to take a quick look at another case study. So in 2022, a group of Canadian universities actually came together to develop a common ESG questionnaire for asset managers. I'm sure we can share the link with you if we haven't already. But what these universities were trying to do, and some of them will be here at the summit, where they were trying to obtain relevant, meaningful, comparable, and transparent reporting from their asset managers on ESG performance. They collaborated, they came up with a common set of questions, and what they ultimately actually decided was that they wanted to make the questionnaire that they put together public. So it is currently made available on SHARE's website. And last year, a new updated version of the questionnaire was put out, so a 2024 questionnaire. What's handy about that, I know folks have been asking about resources as well, is that there's some definitions at the outset of the questionnaire that are useful, and the questionnaire asks various things of asset managers. One example is, for example, it could ask the asset manager if they are using processes to identify and assess systemic risks. So systemic risks being risks that you can't diversify from, risks like geopolitical risk, inequality, climate change, et cetera. So yeah, again, it's a really useful resource that any of the asset owners in the room can use. That brings me to the end of my presentation. Okay, well, thank you so much for having me up here. I appreciate it. Thanks, folks.